So let's talk about compound interest. Compound interest is the means of earning money on previous interest earned. That can make a huge difference in terms of the outcome down the line. And generally, if you're talking about compound interest over the short term, it's not necessarily something that's perceived to make a significant difference. But playing out over a long period of time, it can make a massive difference to the amount of money you make. For example, if I earn 10% in 1 year and I have $1,000, then of course I'm going to have $1,100. By year 2, if I don't roll that $100 into it and invest that as well, then I'm just going to earn another $100 next year instead of earning $110 next year, because I'm earning 10% on that additional $100. On this occasion, the example only highlights a difference of $100. It doesn't seem like a particularly big amount of money. But if you're able to do this over a longer time frame, or if you're able to gain a more reliable rate of return, or if you're able to put in a bigger amount of money from the onset, or if you're able to put in money additionally yourself, these are all different ways to enhance the compound interest process. So let's take you through some examples and highlight exactly why this is relevant to a trader and the potential implications going forward. This is a 40-year chart of compound interest. If you're able to get a 10% annual return and you started off with 0, so no initial payment, but every month you put in $160. Essentially, I'm trying to get you to $1 million, right? So that's why I've chosen $160. The 10% annual return, well, why are we talking about that? We're talking about 10% because that is the long-term average for the S&P 500. So if we're talking about the outperformance of the S&P 500 and the reliability of it, that feeds into this compound interest sort of metric. So again, like I said, you can either heavily invest at the beginning if you have a lump sum, and then just keep reinvesting any returns over and over again if they come back as a coupon or a dividend. Otherwise, you can start from very little and just keep adding to the pile, and then those additional payments are then sort of added into this compound interest process. But essentially, over this 40-year time frame, by paying $160 per month, you're talking about a massive return at the back end, and that's when it's really kicking in, right? So it's, if you look here, say by year 30, you're talking about maybe $350,000. Not bad, but the point is that that's 30 out of 40 of the years already gone, and it's that additional 10 years that things really ramp up and go from, say, 350,000 up to 1 million. So that's the time frame that really does provide the basis for this. It's a lot of different opinions about why compound interest works or doesn't work. And a lot of people will say, like, compound interest, you know, it's something people talk about, but no one becomes millionaires off of this. Well, that's because a lot of the time people don't have the longevity, right? I understand it, right? You might be looking at this right now, you might be talking about compound interest, but you might be aged 60, for example. You might think, I don't have 40 years to be doing this. And a lot of times we are in a position where we get into financial interests like trading or investing relatively late in life. A lot of people don't look into these things when they're 20, for example, or 15. So there's different ways to look at this, right? So you could either fast track this process by putting in more money now, or you can fast track it by putting more money in on a monthly basis. Obviously, you don't have to get to $1 million as well, so the target can be different as well. So there's a number of different things that you can sort of put into this calculation that speed up the process. And that would be initial deposit, regular deposits, and the rate of return. So 10% annual return, you know, that as a regular basis from the S&P 500 is very good, you know. But if you can beat that, then of course that it will make the process more reliable. Another way of looking at this is as well is that this can, and it's relevant to me because I'm a young baby, this can be the kind of thing that you see as the basis for other members in your family. You don't have to wait until your child has grown up to become 25 and now has an interest in financial markets and economics. You don't have to wait until then for you to be able to invest for them, right? So setting aside some money, putting it into an S&P 500 investment, things like that, putting regular money into S&P 500 futures or alike, that's the kind of thing that, right now is just playing out for the future. And it's exactly what I have done. My baby's 8 months old, but he's already got an account and I'm paying in on a monthly basis because I know the power of compound interest. I know the power of initial investment. I know the power of regular returns. And I know the power of adding a little bit each month. And that's exactly what I'm doing. And that's why I wanted to highlight that to you guys as well. A different way of doing it, like I said, is initial deposit. Again, I'm looking to try and get up to that 1 million mark in 40 years. And so that could be a case of a 20-year-old that starts doing this. And by the age they're 60, they could potentially become a millionaire if you're utilizing historical numbers, if we maintain a 10% return each time, like the S&P 500 has provided. So you can see here at the bottom of it, right, that blue section, that is the initial deposit. That's your 20,000 on this occasion. So of course I've utilized 20,000 because that's the calculation I worked out will get me to 1 million. And notably, all of these numbers, you don't need to aim for $1 million. You don't need to put in 20,000. You can put more, you can put less, you can aim for less, you can aim for a shorter time frame. So I'd implore you to look up a compound interest calculator. And it's fun to play around with, quite frankly. I mean, ultimately, it highlights the value of investing over the long term, reinvesting any dividends or payouts. Compound interest, they're sort of playing around with, how much do I have to put in at the beginning? Maybe if I put in regular amounts and where will I get from that? But it's really powerful. It takes a bit of time, but, ultimately, time is the what you have to try and make money a lot of time, right? And you shouldn't only think over the short term. But you can ramp up compound interest utilizing trading. And here's why I think it's particularly powerful within the trading space alongside investing, right? So take, for example, the idea the S&P 500 pays out 10% per year, right? So 10% per year is a very good return, no doubt. Then try and have a think about the last time you traded, how much of your account size you risked, right? A lot of the time, people are risking 10%, 20%, 30% of their account in a single trade that could be over within the space of 30 minutes or something, right? So I'm not necessarily telling you to do exactly that because, as we'll go on to, the position sizing is absolutely key to staying alive in this game. But my point is, if you are taking relatively safe bet trades, things that you have very high conviction in, and risking relatively low amounts of your portfolio, it may feel like you're going nowhere fast, right? You're not going to double your account in like a few days, and you're not going to become a millionaire by the end of the week, but you're not going to blow up your account in the same way either. And if you look at this breakdown here, which I'll take you through, you can actually see some incredible returns by actually focusing on essentially compound interest with investing, but trying to do that with a trading account, knowing full well that you can, instead of getting 10% over the course of a year, you can get 10% over the course of a month, or 6% return, or 4%. Very achievable if you're trading with, say, a 3% per trade, right? 3% of your portfolio doesn't seem like a lot because a lot of the time people want to see huge gains each time. But if you think of that 3% in relation to that 10% annual return for the S&P 500, all of a sudden you think, wow, I made 3% of my portfolio. That means, on my trading portfolio, that means that I'm a third of the way towards getting the average annual return for the S&P 500. So let's say, for example, we're risking 2% of our portfolio per trade. Over the course of a month, I would like to think you can get above the sort of zero line to the extent of what? So how many more trades, let's say you're hitting trades on a 50-50 basis. So my stop loss and my take profit are equal distances. So essentially at that point, you just have to be able to be better than a coin toss, right? You just have to gain a little bit of an edge in terms of your market knowledge or your technical analysis to be able to be right on a coin toss trade more often than you're wrong, right? So let's say, for example, you get 2 trades right over the amount that you got wrong. On this occasion, it would be, say, 4% monthly gain. So let's say you have a $5,000, if you have a sort of five grand return, you're talking about $5,000 account, you'll be talking about a rise to 52,000 over the course of 5 years, right? So these returns are 5-year returns. So $52,000 from a $5,000 account over 5 years. And what you did over that period, well, it was essentially little and often gains, trying to essentially do compound interest on the trading space rather than the investment space. So again, let's ramp it up. If you had a $10,000 account and you managed to get 6% return per month, so essentially if you're risking, maybe you're doing a 3% of your account risk per trade, that would mean, again, 2 trades over and above your losing trades. Right. Yeah, so we're not talking about something that's impossible, right? I'm not telling you that you've got to hit a 7-to-1 trade or anything. I'm just saying if you were taking trades that are even trades, right? Your profit, it's a take profit and your stop loss at equal distances, and then you're just focusing on being right more than you're wrong, and you have to be right 2 times more than you're wrong. That would be that 6% monthly return. If you had a $10,000 account and 5 years later, you'd be talking about $330,000. And this highlights why essentially compound interest is really interesting for investing. And I'm all on board with it. Yeah, and I do it, right? And I play the long game. But you also can factor that into the short term. And you can also look at that over the short term. And it highlights the importance of staying in the game, of regular returns, of just trying to get something at the end of the month that is like, I've made 4%, I've made 5%, I've made 6%. Things like that don't impress yourself a lot of the time, right? A lot of the time you'll be looking at it and thinking, okay, fine, I made 5% of my account. It doesn't look like a huge amount of money, because I know that with trading, I can triple my account over the space of 3 weeks. If you're tripling the account in the space of a few weeks, then you have a much higher likeliness of blowing up as well.